Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the markets, as I do every kind of midweek, and give you some information that you really should have and really can use within your retirement portfolio. We've been getting more questions and more questions about not only the bond market and really, why am I concerned for interest rates eventually moving up and what's going to happen to bond investments. We received probably 5 different calls on the radio show last Sunday alone from individuals really not understanding how the bond market works. And I want to cover that just a little bit because this is going to be an area for many investors where they're going to have the potential to lose a lot of money over time as inflation does come back and the Federal Reserve does raise interest rates back to historical norms. Again, bonds work like a teeter-totter when you were a child. When interest rates go up, bond values go down. Now what ultimately happens is if you own a bond fund, let's say you own, as an example, the PIMCO Total Return Fund. And let's just assume that was a long-term bond fund, which it is not, but the bonds within that portfolio are long-term in nature. And let's say the average bond in that bond fund was 20, 25, 30 years. You can obviously sell that bond fund anytime you wish to, and what you get back is going to be depending on what the share value is for that particular day. But what ultimately happens when you start buying a long-term bond fund or individual bonds, when rates go up, the share price will actually go down. Now, yes, if you buy individual bonds, you can keep those bonds to maturity in 20 years, let's say, and you'll get your principal back, assuming that that institution that issued that bond did not go out of business or default on that bond. The problem is if you buy a 4% bond today that's a 20-year bond, let's say a municipal bond, and rates go up 3 percentage points, you would see that municipal bond, that long-term municipal bond, drop by about 30%. About 10% in value for every 1% interest rate increase that we see. The problem that you're going to have is, yes, you can keep it to maturity, and you can get your interest rate at 4%, the current rate that you had when you bought the bond, and keep that bond to maturity, and again, as long as nothing happens, you'll get your principal back at the end of that 20-year cycle. The problem is current bonds now are paying 3% higher than what you are currently being paid at 4%. So now you can make 7%. So now for the next, let's say, 15 years, you're going to lose out on 3% interest. Also, typically when that happens, inflation's gone up, and another reason for the Feds to increase interest rates. So not only can you lose from the lack of the lower interest rate you're going to receive on your long-term bond holding, but you're also going to lose out because inflation typically would be higher, and it's going to cut away the spending power of the bond that you own because, in essence, you're making lesser rate than what current rates are, competitive rates are today. So again, we've seen the Treasury market start to back up, which means bond values are basically starting to fall because in anticipation of higher rates down the road, the market is already anticipating that. We're seeing the long-term treasuries and long-term munis being hit the most. So you're going to see over time slow erosion of those particular investments. So if you own long-term bonds, own long-term bond funds, or own long-term ETFs, exchange-traded funds that buy bonds, you need to make those adjustments. You need to look for other areas for income purposes, and I've talked about many of those throughout my show. We're going to talk a lot about this week about conflicts of interest and what really is happening to your money. What is that advisor or so-called broker really giving you, and are they really giving you investment advice and investment management, or are you being sold something? I'm going to talk about a case study this week that you will not believe and what happened to this gentleman in his portfolio. But this happens probably to 80% of the people that call our office for a review on the products that this person was sold and why we feel they were harmful to their portfolio. This is Brian Resney. Hopefully this update gave you a little bit more clarity on the bond market and why we're concerned about interest rates. What we're trying to do is protect you when you need to have protection. And remember, there are times you need to make adjustments to your portfolio. Do not be lulled into buy and hold, which is just a lack of investment strategy is all buy and hold is. There's times you need to sell things. There's times you need to make adjustments to your portfolio. This is Brian Resney. We're going to have a great show on Sunday. Make sure you do listen to us. And as always, if you're concerned about your money, if the advice you're getting is not working, and you realize that you actually need a real money manager instead of a salesperson, call our office. It doesn't hurt to talk and get a second opinion. We would love to help you and get your portfolio back on track for 2011. Again, have a great day, and make sure you do listen to our show on Sunday from 10 to noon. It's going to be some very powerful information you're not going to want to miss. Have a great day.